Welcome to our first quarterly newsletter, Q1 of 2023. Let's get right to it. You may have seen the headline, 2022 was the worst year in the market since 2008. As someone who lived through and managed money through the great financial crisis, that feels like a publicity magnet meant to sell papers. 2022 was a bad year in the market. And it was the worst year in the S&P 500 since 2008, yes. But 2008 was double the loss plus some. Let's look at the numbers. Those headline articles use the S&P 500, so here they are. 2022 was down 19.44%. 2008 was down 38.49%. Not only that, but look at the 2 years preceding each bear market. The 3-year average is almost a 45% difference. 2022 was not the close destruction of our entire financial system. It was a bear market, and those happen sometimes in the normal course of long-term investing in stocks. 2022 is still fresh in our memory, so it's easy to remember why it was a down year in the first place. Russia's invasion of Ukraine, snarled supply chains, COVID is still sticking around, China lockdowns, all these events have had an impact. But what is the big reason? Inflation and interest rates. The inflation rate was 1.4% in January of 2021. It climbed steadily from there, and by June of 2022, it was 9.1%, where we're hoping it peaked. The Federal Reserve has a dual mandate of keeping employment high and inflation low. Back in the 70s, economists argued that letting inflation run hot was okay as long as it kept employment up. Once Fed Chairman Volcker was appointed, however, he proved them wrong. He unleashed a tsunami of interest rate increases that topped out at 22%, and that finally quickly destroyed demand enough to rope in inflation, and it's been tamed for 40 years. We learned a lesson in the 70s that you can't let inflation get out of control and that a stop and start approach to taming it doesn't stick. So the Fed is raising interest rates right now to tame inflation, and it will probably continue. But the odds of double-digit interest rates anytime soon are very low. Rates did start moving up in March of 2022, but remember back then they were still zero. In just 9 months, they ended the year at 4.25%. That's the fastest rise in interest rates most of us have ever seen. And it's coming off a decade and a half of rates being zero and near zero. Those are simply shocks that we're not used to. Another thing that we're not used to is bonds having such a terrible year. With rates being stable, bond prices tend to be stable. But with the sharp rise in rates came the sharp decline in bond prices. Many bonds will be fine if held to maturity, but they did not provide the comfort of helping to hold up prices in our portfolio last year. The big question, of course, is where do we go from here? The Federal Reserve has a heavy task at hand and a great balancing act to pull off. Will they land us down softly on the other side, or will 2023 be an economic crash landing? Well, none of us can actually predict the future, but I am paid to have an opinion. And no, I don't believe 2023 will be a crash landing. I do believe the NBER will at some point say, yes, we're in a recession or we were in a recession, but I'm in the camp that thinks it will be shallow. Employment is still strong, and if inflation peaked last summer, then we're looking towards a terminus in interest rates at about 5%. Once we see a leveling in interest rates, and at the first sign that they will stop going up so quickly, bonds could settle and actually be a good value buy. And I feel the markets of haves and have-nots will continue. For example, the communications sector was down 40% last year, while the energy sector was up 60%. Extremes of that nature will most likely continue next year, and looking towards commodity-type investments should continue to benefit, as should healthcare, consumer staples, and REITs. I'm often asked if I've seen one report or another from a certain analyst or economist, and the truth is, I read almost all of it. Conflicting opinions have been around since the start of the market. I believe it's important to maintain balance and humility in advising and investing because in 30 years, I've witnessed too many very smart experts get it wrong. So I do listen. I lean in directions I feel have the best odds of doing well, but then I stay diversified at the core. So even when I'm wrong or when the experts are wrong, we can hedge against the different outcomes. Your portfolio will be managed with these things in mind. Your goal, is it income, long-term growth, tax avoidance? That's all unique to you. Are you comfortable with short-term risk or can you absolutely not tolerate it? We're all different. And then in the end, I layer on current market trends and analysis. It does matter, but your goals and preferences matter more. 3 quick fun things that I'll leave you with. 1, 2023 will be celebrated in China as the Year of the Rabbit. This is viewed as a year that brings peace, prosperity, and good luck. Number 2, 2023 is also the 3rd year in the presidential cycle. We can't claim that correlation is causation, but history does lean heavily on the 3rd year of a presidential cycle to be positive. And number 3, for more details and information on interest rates, inflation, and how markets have reacted in general to past calamities, I've put together some animated videos for you. It helps us all keep things in perspective. I can hardly express to you how happy I am to finally be able to communicate with you in this format now. I really enjoy managing portfolios, and I say this all the time, but it's true. Talking to you is the best part of my everyday. I wish you and yours happiness and prosperity in 2023. I have a lot of fun updates as we go along on my YouTube channel, and you'll see me back here for a Q2 review in April. See you there.